Right, everybody. So back again doing another video. This one is a question from someone on Instagram in regards to kind of like how accounts work, like different types of investment accounts. So I had a glass of wine and I did this fancy little picture, which is the same thing that I draw for clients when I'm in meetings. Alrighty, so this is my little picture I drew here. There's three main types of accounts when you're doing investments. There's a registered retirement savings plan, a tax-free savings account, and then a non-registered. A non-registered account is just nothing. That's like an account that has nothing to do with um, any kind of government benefit plan. So first one here is an RSP. You contribute to an RSP, and every dollar you contribute is a dollar less taxed on your income. So in a different video I showed, if you made $150,000, your tax that you owe would be 41 grand. If you made $100,000, the tax you owe is 21,000. Now, if you made $150,000 and you put 50 grand into an RSP, you would pay the same amount of tax as if you made 100,000. Okay. RSPs, if you make a low income, so the first tax bracket's around $43,000. If you make a low income, there's not a lot of reason to put money into an RSP because they give you, think about it this way, right? So if you put 10 bucks in an RSP today, they'll give you $3 back. Okay. In 30 years, that RSP, that 10 bucks you put in will be $30. When you take it out, they tax you on that. So it makes no sense if you're only getting, if you're at a low tax bracket to get, a couple bucks back now. So in the future, you have to pay $6 on that same money instead of the $2 you got now. It's more complicated. Obviously, when I deal with clients, I do a more detailed analysis, but the main thing is high income, do RSPs, low income, don't do RSPs, okay? But what happens is you have a limited amount of room. So you get 28% of whatever you make that year. So if you made 100 grand of income this year, then you'd have 28,000 of contribution room for your RSP next year. Even if you don't use it, you keep that room up to a limit of, I think this year was like I said, 28,000. So if you make $1 million, you don't get $280,000 worth of room. It's still, there's a max out so that people don't just put huge contributions in and never pay tax. So you put the money in, you get a tax refund. That's the whole idea. You can put it into any investment you want. So there's GICs, stocks. You could put it into crypto. You could put it into, there's a way to do real estate. You can put mortgages in your RSP. It doesn't matter what's in there, but you have investments inside your RSP. They are supposed to grow. You do not pay tax on the growth. You pay tax on the withdrawal. So if you take 10 grand out of your RSP, what will happen is they will add 10 grand to your taxes in that year. If you take 200,000 out of your RSP, they will add 200,000 to your taxes as if you made it working. Okay. So you don't want to take money out of your RSP until you aren't working anymore. And then you have a much lower tax bracket. Okay. Tax-free savings account. So these things should have been called tax-free savings plans, because I meet people all the time that have cash sitting in their tax-free savings account, which is the absolute worst way to use it. You get $6,000 a year in room, but some years it was 10,000, other years it was $5,000 or $5,500. So depending on your age, there's a different amount that you have. I'm 40. I have $81,500 worth of room in my TFSA. Put money in your TFSA. You can invest in anything you want, really, and any growth that you get. So let's say you invested 10 grand and grew to 100 grand. You don't have to pay tax on that. A lot of times if clients or anybody, if you have money to invest and you don't need to do an RSP contribution, you definitely want to put it into your tax-free savings account. In a perfect world, you retire with $1 million in that account and you never have to pay tax on it. Like I have some clients that, because the way we've structured it, like they have a lot of money, but it looks like they're under the poverty level in terms of their income because they only actually show making like, 23 grand of taxable income. So tax-free savings account, this is where you put anything that you think is going to grow a lot. So if you go to the RSP, right? So let's say you bought a cannabis stock it went up 1,000%. That's awesome. But now you have to pay tax on that 1,000% growth when you pull it out, right? In the TFSA, this is where I tell clients to put all their stuff that's more exciting because you don't have to pay any tax on it. It's a pretty awesome account. And then the last account is a non-registered account. So fancy name for an account where you aren't contributing to anything. The government's not really involved. It's not some special plan. It's just a cash account where you're buying whatever investments you want. The money put in is called your cost base. That's your starting point for buying a investment. You don't get any tax break or anything for that. The tax break comes on your investment. So this is any type of investment in Canada. So it could be a rental property, it could be a dog, it could be a coin, anything that you own that goes up in value and then you sell it, you're supposed to claim that. Okay. And this is a big thing for crypto investors because get ready, they're going to start coming after you. I don't know if anybody's actually up any money this year, but if you are, when you sell it, or let's say you change it from Bitcoin to a stable coin, if there is any left, that's a taxable disposition. You technically are supposed to claim half of that on your income. So if you made 200 grand, you are supposed to claim $100,000 on your income, and then you get taxed at that tax bracket. So if you made 100 grand from work and then you sold an investment and you made 200 grand on that, when you file your taxes, you have to pay taxes if you made $200,000 that year. But it is a benefit, right? Because you only have to claim half. So it's still a heck of a lot better than money that you make working, because money that you make working is just taxed fully. The other thing is that if you get paid a dividend, so when you invest in things, like if you invest in a piece of CIBC, every 3 months, you get a piece of their billions of dollars of profit. That's called a dividend, okay? The dividend is already taxed to the corporation. So the way I describe a dividend, it's not the most technical way to say it, but it's like you're paying the difference between what the company, CIBC, already paid to the government and your own personal tax bracket. Still, way less than if you actually made that working. So long and short of this whole thing is there's different accounts you have to use for different purposes. Everyone should be using a TFSA. RSPs aren't for everybody. So don't just put money in an RSP if you don't have a high income, which warrants it. If you make a lot of growth on something, you have to be careful when you sell it because it's going to trigger capital gains. Yeah. And I mean, that's it. This is the thing, whenever I'm on social media, I see all these, all these videos of like coaching and, 10K academies and, make all this money, and that's great. But at some point, you need to stop and you want to relax and not have to be making phone calls or actually working. This is the end game. You want to have a combination of these accounts where they're all growing and they're all providing you with some sort of income, and you're doing nothing but drinking beers on a beach in Hawaii, right? So hopefully that helps. I'm going to do another video where I go over, the different types of investments, because like I said, the tax-free savings account, people are just getting screwed because they have these accounts and they're not invested in anything, which completely defeats the purpose of having a tax-free savings account. So I'll go over that. Like I said, too, I'm going to put the link to Planswell. Send me a Planswell submission. It's confidential. I will look at your situation and do a video on how I think you can get better prepared for the future. I mean, it's worth it too, just to like send it to me and I can look at it and go, hey, you're awesome. This is how great you're doing. This is how much money you're going to have in 10 years. This is when you can retire. Like usually to get this type of information, you have to have, like, to deal with a financial planner, you usually have to have like 100 grand at least to sit down with someone who has their CFP designation. It's like like doctors have PhD. Well, real financial planners have a CFP, certified financial planner, like little designation behind their name. That's how you know you're dealing with someone who actually has experience and knows what they're talking about. So yeah, hope that helps. Have a good one.